Welcome everybody to Volatility Trading Strategies. So in the last few years, we've seen the explosive growth of a handful of tech companies leading the global AI race. Investors need exposure to this exciting growth industry, but at the same time, it's going to be a wild ride with huge drawdowns along the way, so risk management is especially important in the tech sector. Today I'm going to go over the full details of our defensive rotation strategy. Trading live now for over 10 years, it targets a higher rate of return, but also manages risk exceptionally well. Make sure you claim your free VTS trial. So my total portfolio solution is currently 3 independent tactical strategies, all with their own volatility metrics, asset classes, and threshold levels, so they all work together to produce our market-crushing return. The defensive rotation strategy that I'm showing you today is 1/3 of that portfolio. It's a tactical rotation strategy, which means it's rules-based and it's going to be allocating to different asset classes depending on the current market environment. Now, for me as a volatility trader, I'm not relying on gut instincts or market predictions. The volatility complex is by far the best place to get reliable trade signals, so that's what it's all based on. How it works is I'm able to priority rank all the important volatility metrics, and then we only allocate capital to the asset class that has the highest probability of success, given the current market environment. Now, the heart of the strategy is equities-based, and anytime volatility is in what we consider mid to low levels, basically stable markets, we'll be holding the NASDAQ index in the form of the 2x leveraged ETF called QLD. Now this chart here is showing just the days when the strategy was holding that QLD, and we can see that happens on about 63% of trading days. These are only the most advantageous days during stable markets, and that's very important. Aside from a quick drop and then a fast recovery after COVID, it has actually been a very long bull market, and a lot of investors have forgotten just how bad things can get when you're holding stocks. This is the 2x leveraged QLD during the financial crisis in 2008, and that's an 84% drawdown you're looking at, and it took over 5 years to recover and finally clear the previous high from 2007. And for this one, it should have an R rating stamp on it, because here is just the 1x non-leveraged NASDAQ index going back to 1999. There's no leverage being used here, and that's an 83% drawdown with a full 16 years of recovery just to clear that previous high in 2000. That's what happens when investors don't have an effective trading system for drawdown reduction. So when volatility starts to get elevated, we rotate out of stocks completely and we move into the XLU, which is a utilities ETF. Utilities perform much better than the stock market during times of elevated risk and uncertainty. Here's just those XLU utilities positions that are held on roughly 16% of trading days. It's just a safety position, but it's extremely important for the overall strategy to have an exit plan before the real trouble arises. Remember, despite the massive government and Federal Reserve intervention we've seen, at some point there's going to be another financial crisis. Now, I have a good plan for exactly how I'm going to handle it, and you better make sure you do as well, because the next recession, given that the puppet masters have got to be out of bullets at this point, it could be one for the record books. And that's where this next position comes in, because on about 8% of trading days with the most extreme high volatility readings, during those times when the market is crashing, we move entirely to cash and wait safely on the sidelines. Here's an overlay, and all those red periods are when the defensive rotation strategy was in actual cash. The underlying black line there is the S&P 500, and we can see that we've got to move to full cash during those larger market drawdowns. Now, sometimes they bounce back pretty quickly, but like I said, there's going to be a time in the future when it really doesn't. And that's when our safety positions really pay off for us by avoiding the worst of the crisis. And then the last part of the strategy is what we do during very low periods of volatility. We only see these very low levels of volatility during longer trends of stability, and by that time, typically the stock market is running on fumes anyway and looking for a short-term pullback. So when we do get into that lower volatility range, we also shift into cash just to avoid some of those reversals. Remember, during the next recession, it's not going to be surprising at all to see the NASDAQ index drop 70 or 80%. And it could take 5 or 10 years to recover after that, so this is why we take our safety positions seriously. And I've made it very easy to follow for subscribers of VTS. Whenever there's a new trade required, it's clearly marked in both an easy-to-read table, and there's a trade dial as well for signals at a glance. And you just go into your trading software and execute it. And as far as trade frequency goes, the strategy itself averages about 3 trades per month, so we're only talking about maybe 10 minutes of actual trading spread out over a whole month. Trust me, anybody from any background can easily follow this strategy. And that means you can capitalize on the global AI race while still managing the risk that is sure to come with it. So make sure you claim your free trial to VTS and check out how this defensive rotation strategy can change your investing future. So now you're ready to see how all of our strategies combine to form what I call the total portfolio solution. Again, no more than 5 minutes a day, but volatility targeting is the best way to ensure a smoother investing experience with a higher rate of return. So make sure you check out this video next. See you next time.